Treasury notes are a kind of government issued bonds, so to say. They are almost like equivalent to bonds. They have similar characteristics issued by the government of any given nation. So in this video, I want to look at the features, the characteristics of a typical treasury notes. So number one feature we must be familiar with is medium-term investments. Medium-term investment. Treasury notes are U.S. government securities with maturity ranging from 2 to 10 years, offering a kind of medium-term investment options. Unlike bonds can go for as much as 30, 40 years. Treasury notes, essentially, the maturities, kind of ranges between 2 to 10 years. So it provides opportunities for short-term investors to be able to generate income, generate returns. Number two is fixed interest payments. Treasury notes pay regular interest, regular coupon. Payment could be every six months until maturity. So by so doing, they provide regular, stable, steady income, steady stream of income for investors in these securities. Number three is issued at par. There's that when you talk about par value, you're talking about the face value of these bonds. So treasury notes are typically issued at face value, known as par value, meaning investors purchase them, for their stated value and receive interest payment, throughout the tenure of the duration of these bonds. So you buy at face value, you hold them for as long as it's necessary, and you keep on collecting interest payments regularly. Number four is safe and low risk. It is safe and it's relatively less risky. So like all U.S. government instruments, as well as any other country you are based in, treasury notes are backed by the government issuing it. So making it a kind of low risk investment when it comes to the risk of default. There's always that minimal risk of default. If a government, default on its notes, that means the country is going through real, tangible economic crisis. So most governments don't default on their bonds because the implication is that the ripple effects could be quite enormous. Investors will lose confidence in the government, and other government will lose interest in the country completely. So they hardly ever do that. It happens, but is quite minimal. Number five is tax advantages. The interest income from treasury notes is exempt from states and local government tax, although it may be subjected to federal income tax anyway. The federal government will come in and take part of it as their tax, but the states and the local government will not touch the interest when it comes to taxation. So there's that tax advantage. You're only taxed by the federal government and nothing more than that. Please subscribe to this channel. It will help me a lot, and also like this video if you've not done that. Number six is liquidity. So treasury notes are actively traded in the secondary markets, providing high liquidity to investors who would want to trade their bonds before maturity. You can very easily go in and then you have a ready market, all things being equal, to trade your bonds, and then you recover your capital. So it's somewhat liquid, almost like the stocks in the stock market. Number 7 is auction process. Auction process. So treasury notes are issued through regular auctions, held by the U.S. Treasury and other governments, other relevant government bodies, depending on the country, anywhere. So where investors can participate in a competitive, or non-competitive bidding process. People bid, and then they buy at the highest bidder would be able to buy, be able to invest. Number 8 is a minimum investment. The minimum purchase amount for treasury notes is typically $100 for those in the US, with an increment of $100, thereafter. The initial amount is $100. So incrementally, you can buy 100 more, 100 more, 100 more. So they are issued in the denomination of $100. So number 9 is it is widely used by institutions. So treasury notes are a popular investment choice for institutional investors. They have the capital, they have the wherewithal, the money to be able to invest in a big way, and they stand to equally, profit in a big way. So, investors like pension funds and sometimes even government funds or even governments could equally invest in them due to their safety, the liquidity, and the relatively longer duration compared to treasury bills. Treasury bills, are of a shorter duration than treasury bonds. All right, I think than treasury notes. I think I will come to that in a separate video. So that length, that maturity period is somewhat longer than what is obtainable if you are buying treasury bills. Number 10 is market sensitivity. Treasury notes can be sensitive to changing interest rates. This particular concept is applicable to all kinds of bond investing, because there's that inverse relationship between bond price and fluctuation in interest rates. If interest rate goes up, bond yield will go down, and if interest rates goes down, bond yield will then climb invariably. And so these the impact is less significant than for long-term bonds. Compared to long-term bonds, the impact of interest rate fluctuation on treasury notes is somewhat minimal. So these features make treasury notes an appealing options for investors seeking a balance between safety, between regular steady income, and who want to invest for the short term. They want to invest for the short term between 2 and 10 years. You can go for treasury notes. Anything less than that, you could go for treasury bills. And anything more than that, you can even go for government bonds. It depends on your time horizon and also your risk appetite.